Welcome back, everyone. We have some exciting news to get into. Apple, Meta, and Amazon all reported earnings. And these earnings are not usual. They are very unusual. Amazon is flexing its operating leverage, posting free cash flow numbers that are completely absurd. And we're going to show this visualized, what these free cash flow numbers really look like, because it's insane. The numbers that Amazon's posting are truly insane. Amazon stock, as a result, right now, is up almost 6% after hours. So investors like what they're seeing with their results, and they like what they're seeing with their forecasts. But we're going to be breaking it down in detail in this episode. Now, of course, we have Meta. Meta is now officially a dividend-paying company. They just issued their first dividend, or at least news that they're going to pay their first dividend, and now they're presumably a dividend growth company. They started off with 50 cents per share, which is a small dividend, but they're likely going to grow that amount every single year. So Meta is now a dividend growth company. When we look at this, Meta is also getting a lot of love from the market. It's just racing up. 14% in the green now. Incredible to see this. Meta crushed their earnings. We're going to be looking at the results as well. Now, we have Apple, which is a little bit slower growing right now. The company's slowed down. We had a pull forward effect from 2020. Investors are a bit cautious about Apple, especially with China. So the stock is selling off a little bit right now. It's down 1.7%. We're going to be looking at their earnings report as well. So we have a lot to get to in this episode, a lot to go over. Let's go ahead and start off with Amazon. The first thing I have to mention is I have a massive investment in Amazon. So I love the company. I'm biased because I'm invested in it, but I see it as a terrific investment. And the entire thesis has been that this company that historically has not produced a lot of cash, but has held the potential to, is finally going to produce a lot of cash. Off of that thesis, I've invested over $60,000 in this company. I'm currently only in the green by $9,000, and I've held this company through dramatic sell-offs. So what I'm trying to see now in these earnings reports are massive, expansive growth in cash flows. They're going to accomplish that through a few different means. They accomplish it through AWS, they accomplish it through their normal revenue growth, and they accomplish that through their advertising business. So I want to see all those core drivers of their intrinsic value moving upwards. Now, right off the bat, we have from CNBC that Amazon grew their revenue by 14%, which is just incredible. A company this size with this much revenue growing that fast, that is absolutely incredible. It goes to show that a company that's already massive can still grow. A lot of people act like Amazon's growth is going to slow down, but the world's a very large place, and Amazon is an internet-related business, so it continues to grow very quickly. Now, when I look at the results here, we have some of the key metrics. The earnings was a beat, a strong beat, at $1 per share compared to 80 cents expected. The revenue was $170 billion versus $166 billion in the quarter. So they beat on their earnings per share, they beat on their revenue. And this is the quarterly revenue, $170 billion in a single quarter. That's so much money that this company rakes in. Now, we get to the higher margin parts of this business. Amazon's web services did $24.2 billion, which was on the dot with expectations. This is a very important part. If they missed on this, the stock would likely be in the red a bit. This is 13% growth year over year. Last year, they grew at 12%. So they're re-accelerating growth back into the positive. So even though this wasn't a blowout AWS quarter, it was good. They met expectations, and Amazon Web Services is still remaining competitive and growing quickly. Now, next up, we have advertising. Advertising was $14.7 billion versus the street's $14.2 expected. So they beat by a decent margin on their advertising business, which I think is of equal value as AWS. I think the advertising has as much potential as AWS. And that's surprising to say because only 3 or 4 years ago, it seemed like the only part of Amazon that made money was AWS. And then this advertising business just kind of snuck in there out of nowhere. And now it's a monstrously huge, profitable part of the company. So to summarize just the key takeaways, Amazon beat, and this is for last quarter. This is not their forecast. But to summarize the key takeaways on last quarter, they beat on their earnings per share, they beat on their revenue, they matched their AWS expectation, and they beat strongly on their advertising. That looks like a fantastic quarter by the metrics. Then we move on to the forecasting of the future. Amazon said the first quarter sales will be between $138 billion and $143.5 billion. Amazon always does this where they get a range of what they think it will be. Now, analysts are expecting 142.1 billion. So you might say, well, they're probably not going to hit that because that's on the high end of their range. But if you actually map out quarter by quarter their expectations that Amazon has given historically and the range of reality, what it's came in, it's almost always on the high end. Amazon always gives this range, and like 90% of the time, they come in at the high end of the range. I've seen the visual of it. So there's a strong chance, around a 90% chance, they're going to come closer to this number than this one, which will likely beat these analyst estimates. So overall, I think their forecast was really strong. Now, if we look at the earnings report here, let's go ahead and bring it up. There's so much information in Amazon's earnings report. I mean, it's just, you can get swamped in the level of detail they give. It's pages and pages and pages because they have a monstrous, massive breadth of businesses. So there's a lot of details you can read in. I want to skip down to the free cash flow of the company and take a look at that. They say that the free cash flow improved to an inflow of 36.8 billion in the trailing 12 months. So in 2023, they earned $36.8 billion in free cash flow for the year. That is compared to an outflow of 11.6 billion for the trailing 12 months ended December 31st, 2022. So 2022, they lost free cash flow. In 2023, they earned 36 billion. This is how difficult it is to do analysis on a company with this much cash flow. It's incredibly difficult. So you can see the huge, dramatic swings in operating leverage and the dramatic impact that operating leverage has on their cash flows, going from minus 11.6 billion to positive 36 billion. Now, I also want to look at the cash flow statement to see what this most recent quarter looks like. It's this second column right here. So you can follow along. If we look at the net cash provided by operating activities, this is what we start with, and then we subtract out the purchase of property and equipment. That is the CapEx. So to get the free cash flow number, it's this number minus this number, which is a total of $28 billion. $28 billion in the quarter. Not in the full year of 2023, just in the quarter. I almost feel like we've entered this time period that's been prophesied and talked about. Fortune tellers have said that Amazon one day is going to make money. They're one day going to make a lot of money. Just you wait and see. And investors in Amazon have had to wait patiently. They've waited year after year after year for that time period to come. And it's finally happening. Amazon is finally starting to make some money. Let's go ahead and take a look at how this is represented visually. If we look at Amazon and we look at the free cash flow, the last quarter that was just reported is not entered into Qualtrim yet. The most recent quarter that's actually the highest amount, so the second highest quarter to this most recent one, is 15.61 billion. So $15.5 billion compared to 28 billion. Amazon's most recent quarter will look like this. We'll go to 20 right here, and then we'll speed up to 25, and then we'll go all the way up to 28. That's what it's going to look like. It'll look like a mistake. People look at this and say, is that right? It looks wacky. There's one quarter that's massively spiked over all the other ones. There must be some data issue or something. Nope, that's reality. Those are the real numbers right from their earnings report. $28 billion in free cash flow. And we can look at this on the full year of 2023. We switch this over to annually. Now we look at this chart. In 2022, it was minus 16 billion, and then they said they earned $36 billion in 2023. So that'd be right around there. That's what it's going to look like. It's incredible, the chart that this fills in, because if you look at it, it's almost a 45-degree slope of cash flows with 2 years that were heavily negative while they did all this reinvestment. They built out CapEx, they doubled their fulfillment network, they bought a lot of robots, and they bought a lot of Rivian vans and airplanes and all of this stuff. And they did all of that with hopes that they'd get a return on all of that investment. And now you're seeing this delayed return on investment. My thoughts are that this year, 2024, Amazon will generate around $70 billion of free cash flow, which is, it's through the roof on this chart. It's going to spike this year big time. The story is on track, and them proving it this last year in 2023 shows that they can do this. They really have a lot of operating leverage. There's so much continued potential free cash flow growth in this company. I'm very excited to see it. I think it's appropriate and warranted for investors in Amazon to be thrilled with this report. I think they should sigh a breath of relief. They should be very happy to see that the company they're invested in is performing so well economically. The numbers and the stock price, it's going up now above 9%. This is a reflection of the performance of the core metrics of the company. It can no longer be denied. The whole issue with Amazon was this debate of whether or not they can really generate free cash flow, and they're doing it. They are proving so last year, and I think they're going to prove so even more this year. So Amazon is no longer this long-time money-losing company with potentials of profit. It's now just a profitable beast, a company that produces a ton of free cash flow. And I'm excited to see that grow over time. Now, of course, we have to mention Meta. This is truly incredible to see. The stock is up nearly 15%. And Meta is not a company that's been beat down and it's recovering. It's up 15% after being up already over the past year, 109%. So this thing is just on a roll. Meta investors are having a very good time this past year, and for good reason. Mark Zuckerberg has turned this company around. The year of efficiency, focusing on profitability, focusing on the demands of Wall Street to do massive buybacks. He's really hit the nail on the head for everything that Wall Street wanted, and the stock is jumping. Now, Meta shares are up because of a great report. Meta beat on the top and bottom line, $5.33 compared to $4.96. We have $40 billion in revenue compared to $39 billion, so top and bottom line beat. Then, of course, you have a beat on the core metrics of the company. Daily active users they beat on, monthly active users they beat on, average revenue per user they also beat on. Incredible year from Meta. So Meta beat on everything last quarter, and then they also declared this quarter that they're paying a quarterly dividend. So a new quarterly dividend every single quarter. They're probably going to raise it every single year, making this company fit into the category of a dividend growth company. This opens Meta up to a whole new category of investor, all new ETFs. It could be an SCHD. It could be in your favorite dividend ETF. It's a company that's going to grow the dividend over time, has an excellent balance sheet, has really good growth prospects. Now, some people may look at this with a skeptical or even cynical view. They may say that this is a sign that Meta has reached the top. It's now a big, mature company with a little growth ahead of it. That is not accurate. Look at MasterCard or Visa. Look at S&P Global or Moody's. Look at Microsoft for the past 10 years or Intuit. There's many dividend-paying companies that are still fast-growing companies. And I think that Meta will make a fantastic dividend growth company. They have ample free cash flow to afford it. And now that the stock price is a little bit higher, it makes more sense to issue some of the returns through a dividend because you might want to reinvest somewhere else where the stock is a little bit cheaper. So I think this is fantastic news for Meta, for the predictability of it, and it opens the company up to a lot of new ways of new capital. So overall, I think a smart move from Zuckerberg. This overall is a very convincingly strong report from Meta, and I think investors in this company should be very happy with this report. Now, of course, we can't forget about Apple. They just reported their earnings, and they are down 2% after hours. So they're not enjoying this skyrocketing gains after hours like Amazon and Meta, and that makes sense. Look at the situation that Apple's in. They're a big company with flat revenues, flat earnings per share, and a high valuation. They need to show investors that they're still growing and there's still a bright future of growth ahead for Apple to gain momentum and to gain share price. When we look at this earnings report, overall it was actually strong for the quarter. They beat on the top and bottom line. Earnings per share were $2.18 versus $2.10, a nice beat by Apple in the earnings per share. The revenue was also a beat by around $2 billion. This all looks really good. They beat on the iPhone revenue, they beat on the Mac, they came in just under on the iPad. Other services or other product revenue was a beat. Service revenue was also a little bit under. So this is an important one, but $23 billion in services is wild. Incredible by Apple. And then gross margins were 45.9 against 45.3 expected. So gross margins are also higher than expected. And Apple's going to try to keep their gross margins above 45%. Now, overall, again, the big problem with Apple is the lack of growth. Really big company, high valuation, not growing. And investors will tolerate that for a time, but not forever. Me included. If Apple can't continue to grow, then I will eventually sell the stock and put in one that will grow. Even though I've made tremendous gains on this company, I need companies that are growing their top line. Now, on a positive note, there is reason to believe that Apple will grow in the future. Their active install base is now 2.2 billion active installed devices. That is a 10% increase year over year. So the amount of devices people have and are using is bigger, 10% bigger than last year. That means that the ecosystem's bigger. The moat is arguably bigger as a result. So this is both good and bad. I'd say it's a mixed quarter. They beat on their earnings. They didn't give guidance, but the growth is overall just too slow. And if you're an investor that's looking for companies that are both high quality and growing, Apple needs to meet both of those metrics. They can't just be a high quality but stagnant company. But overall, with these 3 earnings reports, I thought they're all pretty good. Definitely Amazon and Meta are the highlight here. Apple's just holding on. That's all for now. Hope you enjoyed. See you in the next one.